Our next guest says retail's comeback is in the early innings. Dan Hurwitz is a former CEO of shopping mall operator DDR. He now runs Raider Hill Advisors. Dan, always great to see you.
Good to see you. Thank you for having me.
Why are we in the early stages? I mean, we just came off the pandemic. The consumer is filled with stimulus. So is that fueling this sort of 9-inning run, if we were going to continue to use this metaphor? Or, I mean, we see the end of the stimulus in front of us. We see the end of the additional unemployment benefits in front of us. Why is there a long run still?
There's a long run because there's enormous pent-up demand, and I think Karen's right. I think a lot of retailers use the pandemic simply to get better. You know, you asked a great question: are people still going to walk by the perfume and the handbags to get upstairs to the women's ready-to-wear at Macy's? They will if they have the right merchandise, and they will if they're a good retailer. And where they suffered in the past was that they were stale and they were tired. And if they use the pandemic, which I think they have and others have as well, to revamp their merchandise and revamp their appeal to the consumer is ready to go. I mean, our savings rates are up. The stimulus is still out there. People have pent-up demand. You know, we're going to have a little bit of a tail off for sure in the summer months, because we always do. But back to school and the holidays should be robust. I'm more concerned about next year, to be honest with you, comping this year's numbers. Because I think this year will continue to be very strong.
Hey, Dan, it's Karen. I actually can't see you, but nice to hear your voice. Can you tell me what I agree with you on this potential bubble into next year, but what does this mean for the malls or the mall REITs?
Well, traffic is up. I mean, one of the things that we have to distinguish right now in retail is that people talk about retail as if it's a single asset class. And the resilience of retail is very different if you have an open-air shopping center versus a mall. Open air has been incredibly resilient. The debt markets are still there. There's a lot of capital chasing those assets. And they went through the pandemic with great strength. The malls did not. And the malls are going to depend on increased traffic, and they're seeing increased traffic. So I think the malls have a much longer way to come back because they dropped much further. We saw real market capitulation in regard to the malls. We really did not see that in open air. And I think we have to sort of distinguish between open air retail and enclosed retail today, because everyone's talking about it as if it's all the same. And what we learned through the pandemic is that it's clearly not.
Hey, Dan, it's Tim. Are we looking at higher margin businesses now that deserve a better multiple? So again, massive investment in e-commerce over the last couple of years, and we can talk about it with Walmart, but obviously we've talked about it with Macy's, we've talked about it with other discretionary retailers. What do you think about this? Do they start paying dividends on gross margins, and is that worth more to us as investors?
I think over time, I think the proof I think this is sort of a show me market in regard to that, Tim. I think, for example, Macy's has done a good job. They have a $10 billion e-commerce business that they don't get a lot of credit for. Why is that? Because they trade like a department store. And I think they have to show really that the e-commerce business is the wave of a future and that the department store is not going to drag it down. I think the market's waiting a little bit to see what's going to happen. But I think ultimately, if they're successful, stores like Macy's and others do deserve to trade at a higher multiple if they can prove themselves worthy of that multiple over time. You know, we're really just starting to get a taste for what the post-pandemic world's going to look like. And certain retailers were strong going into the pandemic, during the pandemic, and they're stronger coming out. Others had to evolve during the pandemic. And I think the market wants to give them a little more time to see if they can prove to us that they're worthy of a higher multiple.
We've been showing a graphic, Dan, of your biggest, your top picks in retail. And I'm wondering, which retailers do you think have emerged weaker during this pandemic? Names that may have been just brought up along with the rest of the sector, but really don't deserve any sort of appreciation.
Well, I think there's no question that there's certain sectors, if you really look at fitness, if you look at the theater business, they have been devastatingly harmed. And they are much weaker than going into the pandemic for obvious reasons. Food and beverage is weaker. Now, whether it has a massive recovery or not, we'll see. People are talking about that, but we still know a very large percentage of the food and beverage retailers went out of business, and they're not coming back. Markets are efficient. There'll be new people that step into those locations, but that business has struggled. There's no question. So I think the experiential retail that everyone was talking about pre-pandemic suffered the most, obviously, during the pandemic. And the retail that people thought was weaker going into the
Right.
pandemic, particularly ready-to-wear apparel,
Yep.
mass merchants, came out much stronger.
Shepard Smith here. Thanks for watching CNBC on YouTube.